Hi, everyone. Welcome to Tobias Financial Advisors' first quarter market update. My name is Matt Sainholtz. I'm the Chief Investment Officer here at Tobias Financial Advisors, and we are excited for you to join us today. Before we dive into our presentation, just a kind of housekeeping rules and some reminders about what we are doing here today. This broadcast, this information that we are presenting is more general in nature. You have your own unique circumstances and personal situations as it relates to your money. So please, if you see anything inside our presentation today that you have more questions about or how it relates to you, please contact your member of Tobias Financial Advisors to discuss your personal situation. On the webinar tool as well, we do accept questions in the chat. So if you see anything you want to ask about, please put a question in. We'll do our best to address those at the end of our presentation. And this is for clients and potential clients of Tobias Financial Advisors. If you have any questions about your individual portfolio or how you can work with Tobias Financial Advisors, please give us a call. Who we are, we were established in 1980. We are a financial planning investment management firm here in Plantation, Florida, just outside of Fort Lauderdale. We manage over $600 million of our clients' assets, and our clients range from business owners to retirees, the widows, and we really service mostly personal financial planning, but we do work with some business owners and work with their retirement plans as well. We have 75 years of cumulative experience amongst our planning team and advisors, and we really value education. Most of our planners, if not all, actually all, are certified financial planners. We have a couple certified public accountants, CPA on our team, chartered financial analysts, CFAs on our team. So we really believe in not only educating ourselves to do what's best for our clients, but also then moving that education forward and providing some insightful information to you, which is really what we're here doing today. As I mentioned, my name is Matt Sainholtz. I've been with Tobias Financial Advisors since 2005 and serve as the Chief Investment Officer of the firm. And we really focus on developing portfolios that are meant to help you succeed in your life. And I help volunteer with the Rotary Club of Weston, fun fact, and we do a lot of good deeds for the community as well. So that's one of my passion projects. I'm happy to have with us today is Catalina Franco Cicero. Hi, Kat.
Hi, Matt. Thank you. I'm very excited to join you here today. I am a wealth advisor and certified financial planner and certified tax specialist. My job really is walking clients through the journey of aligning their money with their values. And I do some volunteering with women's groups. And fun fact about me, I do a lot of Peloton. So if anybody out there has a Peloton, send me a message. I'll send you my hashtag, and we could follow each other. We could work out together. Thank you. So as we focus on financial planning and investment management at the firm, we also have to think about what it is that we can control. And when we are building these portfolios, we're creating this specifically for you and your needs and your values. We're looking at your risk tolerance. We're looking at the time in which you might need your investments, so time horizon. We're looking at how to diversify these portfolios. Sometimes they come very highly concentrated. We're looking at reducing expenses and turnover, and we also want to minimize taxes. We're very tax centric, so as we're making these investments recommendations, we're definitely keeping this top of mind.
Yeah, fitting that we're talking about taxes. As today's April 18th, and today is tax day here in America. So hopefully everyone's filed or gone on extension by now.
Yeah, hopefully. If not, call your CPA or let us know.
Excellent. So we'll take a quick look at the agenda today. We're going to be reviewing what's been happening in the markets and what's been going on in the performance recently in the first quarter of 2023. We'll then turn our attention to some topics of focus that we're hearing in the headlines, what's going on in the economy, the banking sector, as well as what to do with your cash today, given that we're in a higher interest rate environment than we were just 1 year ago. and we'll wrap it up with some more notes about 2023 kind of economic and financial outlook, as well as some insights as to what we're seeing and doing in some of our portfolios. So without further ado, let's jump right into it. So we love to see this. This is kind of the second quarter in a row. We've had some green arrows, meaning we've had positive returns in the financial markets in the first quarter of 2023. The U.S. stock market was up over 7%, and that's actually back to back. Fourth quarter 2022 was up about 7%, just over 7% as well. So we've experienced two good quarters, kind of coming off a pretty dreadful 2022, but we've experienced two good quarters in the financial markets, and that actually continued abroad. International stocks was the leader here. That's developed markets, that's Europe, that's some Japan companies headquartered there. Those economies, or those stock markets, returned over 8%. Emerging market stocks, that's Brazil, China, India, some of the more growth-oriented emerging economies, up almost 4%. And then global real estate at 1.37%. Fixed incomes or bonds returned 3% for the quarter, and that is a combination total return of interest received from your bond investments, but also what interest rates did in the first quarter, and actually some positive returns due to what interest rates did in the marketplace. We see some historical results here. If you look to the bottom right of our chart here, worst quarter ever for fixed income was last year, first quarter, at least in the last 20 years, I should say, back to January 2001. This time last year, we're experiencing fixed income, which is typically the stable part of the portfolio, having some negative 6% return here in the U.S. bond market. And that will show a bit later on, had to do with how quickly the Fed was raising interest rates and the shape of the yield curve. And so the conservative part of the portfolio is back recently with positive returns, but we did live through a pretty negative experience just 1 year ago when we were doing this presentation. So asset class year-to-date returns on the left-hand side of this chart, you see various different types of asset classes that you could invest in, different countries, different types of bonds. So on the top of the chart here, Mexico had a very good first quarter, followed by the NASDAQ Composite, Germany, France, and the Russell 1000 Growth. The Russell 1000 Growth and the NASDAQ, you can kind of mostly think of those as technology stocks. Those were pretty beaten up, pretty good last year in 2022. And so they came back with a vengeance here in the first quarter. And think of some of those tech companies like Apple. Some of those companies have very strong balance sheets and did very well in the first quarter. In the middle, kind of the S&P 500 or the U.S. Without ex-U.S., kind of in that 7% range again. So it's very, very positive quarter to date. On the downside, some of the oil was down with that's a lot of variables that go into oil pricing, but one of the ideas was that potentially a slowdown in the economy in the future may lead to lowering the oil price as well. So not only did we get positive returns, but this is also exciting too. This is the historical volatility. The chart here, what you're looking at is each year back to 2001 across to year-to-date 2023 is the count of single days in the stock market, the U.S. stock market, that was either plus 2% or minus 2%. So this is kind of how volatile the stock market has been. Year to date, we've only seen 2 days that were either plus or minus 2% in the stock market. So that's really, really smooth ride, as we like to say. Last year, for comparison's sake, for 2022, we actually had 46 days that were plus or minus 2%. That was the year we saw Russia coming into Ukraine, the stock interest rates rising, bear market in the stock market. So we've come off those negative or the volatile days. And what's interesting too is last year was split right down the middle. It was 23 positive days and 23 negative days last year to make 46. So it's very difficult to kind of time the market on which days we're going to be good and which days are going to be less. And so far, so good this year. We're seeing a return to a lower volatility. So far, so good. And this chart just kind of shows you visually what that means.
Yeah, Matt, if I could chime in, what I love about this chart and why it's a good reminder to all of us is to stay invested, because there's always going to be ebbs and flows. It's not a matter of if, but when that's going to happen. And so if we are trained well to stay in the market, when these things happen, we got to stay invested. So if you need to take a snapshot of this picture and save it on your computer, take it so that it could bring you a little bit of confidence that even when the market is doing this, there's still opportunities for growth over the long term.
Absolutely, Kat. Absolutely. So looking back in time, as we noted, kind of the last quarter, fourth quarter of 2021 was kind of around the peak of where the stock market was the highest. So, last year we entered a bear market phase, and we had some definite pullbacks in the market. So we're not quite where we were a year ago in the various asset classes. We are still down from that perspective, even though we had this recently great quarter with 7% returns in the stock market. But overall, over 5-year periods, over 10-year periods, generally speaking, the longer that you're in the market, the better. I always love to say investing is not about timing the market. It's about time in the market. You have to be in the market to experience these gains on a year-to-year, a month-to-month basis. Markets are going to shift and turn, but if you're in it and have your capital invested for the long term to let it grow and compound for you, you're usually rewarded over long periods of time.
Yeah, Matt, and what I love about this too is that it shows the diversification, right? That is not just one asset class that is the winner or loser every single time. And that is something that we talk about, especially when we're constructing that portfolio, right? That the ranges that we should be expecting. So this is good for people to see that this is why we develop globally diversified portfolios.
Excellent. Absolutely right. So that was the good news. That's what came in first quarter, very positive. Most asset classes and a balanced portfolio returned a positive return for the quarter. So now we're going to focus on some economic data, some banking sector, and cash management. So first off, let's take a look at the economic growth as measured as the GDP, the gross domestic product. Which is really just a measure of what the U.S. economy or what any economy is doing. The statistics are shown here is about the United States. And we're seeing back to 2001, the trend of the U.S. economy has been growing about 2% on average. Certain periods higher than that, certain periods lower than that. This big V here back in 2020, of course, is the COVID pandemic, which turned out to be a pretty V-shaped recovery, meaning that we had this big downturn, but we got back relatively quickly, and now we're pretty much back to trend line. So quarter 3 of 2022, fourth quarter of 22, we grew in the economy. We're looking like first quarter of 2023 is going to be another growth in the economy, so that we're still chugging along and the economy is still moving forward, which is what we expect. Just a kind of reminder of what makes up the growth in the economy. The U.S. consumer, 68% of the economic output of the economy is driven by consumption or by the consumer. And so that's a really big percentage, of course, to keep in mind when we're thinking about what's upcoming for the economy. Government spending, investment without housing, and housing kind of make up the components of GDP. But, it's positive. Right now, the economy is still growing. In the face of the COVID pandemic, we've come through it. I think that's kind of one of the stories going forward is that, great that COVID is still out there, but it's, mostly under control. And now the economy still continues to grow. So the R word, as I like to call it, we see it in the economy. We see it in the news every time we open up the internet, your favorite webpage, however you get your news. Without any looking too far, you always hear about recession. When is recession happening? The recession's here. There's a recession down the road. When is it? What is it? So we want to just to quickly define what a recession is. It's just pervasive and persistent decline in economic growth. The National Bureau of Economic Research measures and declares a recession. Is sometimes it's traditionally thought of as two negative quarters of economic growth in that GDP, but really it's the National Bureau of Economic Research that kind of defines and tells us exactly when we're in a recession. And on the chart here on the right, it's just a good reminder. It's the economy, just like life, your personal life, kind of everything ebbs and flows. We have expansion, everything's going smoothly, and then something along comes along and kind of slows things down, which is just what that is. It's a recession, it's a slowdown. But over time, use the trend line as I just showed in the previous slide is positive. The economy grows over time, but it does ebb and flow. And when we think about recession, what happens during recession? That could include loss of jobs. If people lose their jobs, there's less consumer spending, less economic activity from businesses, which may lead to less profit. So it's more of a slowdown. It doesn't necessarily have to be as scary as it may sound to some people when you're listening to the financial press. It does happen. It happens throughout time, and we want to be aware of it, but not necessarily scared of a pending recession.
Yeah, and these things happen, Matt. I think that's part of what we're trying to educate our clients and everybody who's here in the audience is that these things are expected and these are cycles, just like the other slide with how many days you may see the volatility in the market. I think it's important to remember that there is also opportunities in a down market, or when the GDP is down. So just keeping that in mind so that you don't let fear take over any actions you take in your portfolio.
Absolutely. Thanks, Kat. So this is kind of a recession radar. These are some various variables that the economic team looks at to determine whether a recession or not. So it's kind of personal income, employment, spending, retail sales, and industrial production, manufacturing production. And so it's kind of like a heat map. So like if you look back in March 2020 when the world shut down effectively for COVID, it was red across the board. This is meaning that they had very little growth or slowing growth in these different sectors here in the economy. And that is indicative of what you're looking at here. So green, we kind of came back. So now we're kind of a mixed bag on some of these different variables, but as we showed earlier, it was still kind of 2% growth throughout the last few quarters. And now we get to 2023, we're kind of in that yellow mark. We're kind of in that yield traffic light signal here where it could continue to slow and maybe turn to red and become a mild recession, or maybe we kind of just trudge along here and then growth continues. Our role is that we're not necessarily that we're building portfolios to kind of weather the storm either way, but this is a good view of what where we're at economically today. I was listening to one of my favorite economists recently, and it was the outlook is for maybe a slowdown in the economy, potentially a recession. But his quote was that we're not overlooking an economic cliff. We're more overlooking kind of like an economic swamp. So it's more, it's going to slow down potentially, but it's not it's not going to be economic destruction. Jamie Dimon, the CEO of JP Morgan last year, said maybe there could be an economic hurricane coming, which got people all fired up. Here we are a year later, or maybe 10 months later, and we are still growing in the economy. And he's revised that terminology, and maybe there is a slowdown, but it's not as potentially scary as we once heard just 9 months ago.
Yeah, I hope that puts people at ease on this call because those headlines are scary, Matt. So thank you for sharing that.
Yeah, so just graphically where the Fed, the US Fed interest rates. So this is going back to 1990, but just look from 21, basically from 21, we went to almost 0% interest rates target to just under 5% now in a very short amount of time. And the reason why the Fed increased rates so fast was because inflation was happening in the economy, and there's a dual mandate with the Fed to kind of promote jobs, but also keep prices in check so we're not having runaway inflation. Currently, the inflation data is coming in more mild. And so the expectation is that maybe at the March meeting here, the Federal Reserve will maybe pause interest rates and let them stabilize for a little bit. And then in the longer run here in the next couple of years, perhaps there might be even interest rate cuts if, in fact, inflation does come under control. So over the longer term, 25 years, 25, 26 down the road, we might see some interest rate cuts. But right now, the Fed's still being firm to making sure that inflation does come back in line. But just pretty remarkable. And that's why I said the bond market was so negative last year. This pace of interest rate increases and how fast it went from 0 to almost 5% caused the bond market, which is pretty stable historically, caused that to have a negative, pretty nasty negative year last year. But as we noted earlier, first quarter this year, we're not seeing that. We're returned to positive in the fixed income world. And this is a repeat from last quarter, but we love this chart so much that we kept it again. We'll go through it here in a moment pretty quickly here. So this green line is industrial production. That's one of the inputs to economic growth. This is saying, before the economic peak in the production, the economy, the industrial, the manufacturers, the factories, they're still producing and they're still going up as far as what they're producing. But what happens is the market, the stock market, is a discounting mechanism, meaning that the way it's priced is based upon a future's earnings and trying to figure out what a company is going to produce in the next year or two as far as profits, and then discounting that back today as to kind of the current value of the stock price or the corporate value. And so what we've seen in previous recessions and with previous market cycles is that the market is actually a pretty good indicator and does a good job of knowing when the economy is going to slow and some of these corporations are going to have a slowdown in earnings. And this is the blue line here is the stock market, the S&P 500. So generally speaking, about 6 months before the recession begins, the stock market starts to downturn. And then the really important here is when production is not even at its bottom yet, this green line is not even at its trough, at the bottom of where it ends, the stock market starts to recover, even 6 months prior to where the production is. And so what this is saying is that even with the scary headlines and then the recession, you can't wait until the economy gives you all these all clear signs to get into the stock market or just to stay invested, because most of the time the market's already calculated that the economy is going to turn around and it's already priced into the market. So it's all about market timing. And the news here is that we've seen the downturn last year in 2022. So far, the past couple quarters, we've seen some return, and that may indicate that there could be a recession, but it may indicate again maybe more of a mild recession in the coming year or so.
Yeah, Matt, and like there's two things here. One is obviously don't get out when the market goes down, right? Pretty clear. And
Yeah.
the other one is to stay invested. And if you are in your earning years, is to continue to invest, because these ebbs and flows present tremendous opportunities. I mean, this is where wealth could significantly be created. I mean, multiplied over decades. So stay invested, because these present many, many good buying opportunities.
Thanks, Kat. And now would you like to give us a little insight into the headlines we're hearing about the banking industry here in the United States?
Yeah. Has anybody heard about this? Did anybody get scared? I mean, of course it's scary, right? And especially, I'm South American, so we often hear about these things in other parts of the world. But when we hear it in the US, we get all shocked and we're like, oh my gosh, what's happening? We believe in the US. And I think the Federal Reserve did a really great job at just calming people's nerves, especially after Silicon Valley, just defaulted essentially, right? They were trying to make their depositors whole. They were trying to, they have put money in bonds. And you just said last year, we had a really terrible time in the bond market. And so the Federal Reserve came in, and I think that's something really important to reassure everybody who's listening, is that the Federal Reserve wants to instill confidence in the banking system, which is why they came in so aggressively and so quickly, so it wouldn't create a contagion, right? So as you're thinking about this, you know, it's important to also think about the number of banks that have experienced these failures. I mean, you have the 2008 and 2009 time, but you also, if you look at it in comparison to what, right? It's always good to have, you know, a baseline. What are we looking at essentially? And here in the United States, we have over 4,800 FDIC insured banks. So really, this is not a lot in comparison to the number of banks that are out there, and the good job that the U.S. government is doing to insure your deposits. But of course, there's some limits to that. So if you're worried about that, we're going to go right into it so that you know how your money is protected, because that's what I would want to know if I were you. And so there's two types of insurance, right? You have the FDIC insurance, which is the Federal Deposit Insurance Corporation. And again, this is where they stepped in, you know, with the previous bank failure. And then you have what is SIPC, which is the Securities Investor Protection Corporation. So you're insuring two different types of accounts. So FDIC is going to insure your savings and your checking, for example, at your local bank. And that is per depositor up to $250,000. So Matt, if you have a bank account at Bank of America, your account is insured up to $250,000, right? And there's a bonus if you and your wife have a joint account, then it's up to $500,000. But if you have $600,000, even in a joint account where you got that double, you know, protection, that extra $100,000 wouldn't be protected, essentially, in case there was a bank failure. Now, the Federal Reserve did something completely different last time. They protected even higher amounts, but it's important for us to keep this in mind. Now, SIPC is a little bit different in that it insures you up to $500,000 per account type. So for example, you could have an IRA, you could have an individual brokerage account, you could have a Roth IRA, you could have a trust, and each of those accounts are insured up to $500,000 at places like TD Ameritrade, Schwab, Fidelity, whatever custodian you have this at. And actually, when I looked at the data, Matt, you know, 99% of any type of brokerage firm failure has actually been taken care of, okay, which I think it reassures the people here in the audience. Now, what it doesn't insure you against is bad investments, right? So if you had bad advice and you invested in a very risky asset, which is part of the review that we do when you first come on board to really analyze the type of investments, securities that you have in your portfolio, you know, it doesn't protect you against that. So if you made a bad decision and you got bad advice, it doesn't protect you against that. But it just ensures that, you know, if something happened to the brokerage firm, that you will be made whole up to the limits. Now, you got to have a backup plan to the backup plan, right? So you have those insurances right there, but we are about long-term investing. And what I really love about this chart, Matt, is that it reminds me of this book I've started reading, and some of you might want to pick it up. It's called The Psychology of Money. And his line that stuck to me is that you got to you got to save like a pessimist, but invest like an optimist. And I think this is perfect right here. You know, because look at all the events that have happened here. You have from 1980, the Latin American debt crisis. You got, you know, 2000 dot-com bubble, 9/11, the global financial crisis, Brexit, the pandemic, which we all know. And then you have the bond market last year, right? So, but even during these timeframes, the market continued to increase over time. So much so that here, if you invested $100,000 in 1980, it would have grown to about $11 million today. I mean, let that settle in for a moment. That's astonishing, right? And that's why we have to say we have to control what we can control. We have to stay invested. We have to stay in the game. So You don't want to put that money in the bank because it's not going to give you the yield that you need in retirement. You got to stay there.
That's cool. I like that line, Kat. Invest optimistically, and there's that R word again. The gray shaded here is recessions throughout this time period. And again, just the point is that recessions happen. It doesn't mean that your investments are going to completely get cut in half percentage wise or go to zero. It's just something that ebbs and flows, and you have to be ready for it. And so this is very telling. And the banking industry has some metrics of how much the banks have in reserve compared to the 2008 Great Financial Crisis. The banking industry is actually pretty strong, and the bigger banks are very well capitalized. So we're looking and we're seeing that the markets didn't even, I mean, there was some volatility, but in the past, if some of these big banks had gone under and the market wasn't ready for it, you would probably just see more of a downturn in the stock market, but it recovered pretty quickly this time around as well. So, let's talk a little about cash management now that we kind of understand the FDIC limits of 250,000. How much cash should I have? What should I be thinking about from a cash perspective?
Absolutely. So I like to say that you don't want to have an emotional and a financial crisis at the same time, Matt, because if there's a crisis that comes your way, you want to be prepared. And I think we do a really great job with our clients. Again, just looking at the net worth statements and saying, where are these accounts and what is the objective of each of these accounts? So when we're looking at an emergency fund, we're saying, okay, what stage of life are you in? Because there's two different categories here that we're looking at in these charts. We're looking at people who are of working age, and we're looking at retirees. And the biggest difference here, when you look at the two of them, is that retirees really need a little bit more of a buffer, because they're depending on their investments and, Social Security and so forth. So you do want to have a buffer for the inevitable curveballs of life, If you are of working age, you could get away with a little bit less, about 3 to 6 months of an emergency fund actually is like a general rule of thumb. But if you are a primary breadwinner for your household, imagine how freaked out you would get if you had an emergency, right? So you want to have these funds available to you so that you could be confident when something happens. What's really important too is like, where are these funds at? And I know we're going to talk a little bit about that, Matt. And once you have this emergency fund, where should we put that money? And how do we think about it individually too? Actually, let me add that before we move on to that, is that there's also a backup to the backup, right? So we have clients that may have a bank account, a checking or a savings. They may also have a high yield savings account. And they also have a brokerage account or a Roth IRA, that if we really had such a huge emergency that we needed to fund, we have these accounts available and ready to make accessible to our clients. So it's important when you're working with an advisor, you actually, we could see your whole entire situation holistically, we could move the right levers depending on what the situation is for the client.
Yeah, absolutely. When we think about emergency funds, kind of that first initial building block that we really talk to our clients about to really establish early on, because as we know, we talked about earlier, the market's up and down, ebb and flow, and we don't want to have to touch the portfolio money in a downturn if we don't have to. So we really want to be very, very cautious and concerned about having some money on the sideline before we even start to invest. And so where do we think about where to put liquid funds? So CDs are a good spot for that truly short-term money, that 3 to 6 months. There's CDs, of course, there's online savings accounts. There's your traditional bank. Let's start there. Your traditional bank has a savings account that maybe pays 1% these days. They traditionally do not pay a lot. So then some online savings accounts, because they don't have so much overhead in their structure, they're able to offer a higher level of savings. So we've seen the invention of online savings accounts over the last decade or plus or so, and those are offering very enticing money market type savings rates for your emergency fund. And Kat, did you do something recently?
Yeah, I read in the news this morning that Apple is going to get into the high yield savings account space pretty soon. So be on the lookout. We're not advocating for a specific bank and certainly not saying, oh, invest and put the money, I mean, put your savings at Apple, but it's you have options. That's what we're saying. You definitely have options. And also they're going to be FDIC insured. Just want to make sure I add that there.
Yeah, so but then just like anything else, we often, well, why don't I put all my money in the short-term CDs because they're paying 5% these days, or I got this great offer from this bank about the CDs. This chart kind of shows that even during the interest rate cycles, and everything's a cycle in the economy and as well as the markets, even at the peak interest rate cycle, the 12 months after that, CDs necessarily don't keep up with inflation, and then you wouldn't want to put everything in the CD because you also get some benefits of interest rate movements when you are invested in things like treasuries or corporate bonds. And so just like we probably wouldn't tell you to put all your stock allocation into one sector or one vehicle, we wouldn't want to put all your fixed income into one sector or one vehicle either. We want to build a diversified portfolio inside of a portfolio, meaning within the fixed income bucket, we still want to be diversified between shorter term cash instruments, shorter term bonds, and then medium dated bonds as well. So really just kind of be aware of what you're investing for. Is it an emergency fund or not, and where to really put it. And we're happy to answer those questions. And that's one of the, as Kat mentioned, it's one of the first things we do when we meet with clients and some newer clients as well, is kind of see where everything is, see if there's any blind spots, label all the type of accounts, and then to really set an asset allocation amongst all the different various accounts they have access to: Roth IRAs, regular IRAs, joint brokerage accounts, and everything in between, really. So as we move forward here, what's going to happen in the rest of 2023? We have points of optimism. Why is the market likely up in the past quarter here? We are seeing some inflation data that's showing that inflation likely has seen a top. And once that occurs and the inflation data starts coming in, that we're not seeing such inflation increases, that the Fed may stop raising interest rates as soon as this upcoming meeting in May. They've slowed the pace of interest rate increases in March, and now they may just stop and let the economy kind of breathe a little bit here and take a slowdown on the interest rate increases. So that has aided in some of the returns that we've seen in the last quarter. The scary thing was last year, and we didn't know if inflation could be kept in check. And people had memories of the 1970s where inflation was at 12, 13, 14%. Right now, we're not seeing that, and hopefully we don't see that. And so that's optimistic. The labor market is still strong. The economy is still adding jobs, and when that happens, the consumer is typically still strong and is able to spend. The labor market right now, there's a statistic out there that there's actually 2 job openings for every job seeker, which is pretty amazing. So that's why the unemployment rate is so low. Yeah. And that's also optimistic that there's still people and jobs to be had. As Kat did a great job mentioning and showcasing, that the banking crisis, although scary in the headlines and some bigger banks did fail, the government did step in right away, kind of slowed things down, and there still might be some ripples in some of the regional banks, and you never know, because the 2021 timeframe, that area of free money and low interest rates, that's gone. The Fed has raised interest rates so high that period of just like no interest rates basically is gone. And so a lot of people need to readjust their economic outlook and how they're positioned based upon a kind of a new interest rate regime, or what's happening with interest rates. So, but good news is banking crisis seems to be okay. And then ultimately stock market valuations, particularly in international markets, we saw in the first quarter, international markets were the leader of market returns. Even with that, international markets still remain attractive. China's COVID policy has kind of been unwound, and that's one of the largest economies in the world. And so we're seeing some growth overseas in some various economies, as well as stock market valuations. So we're big believers in diversifying, and we think international markets are going to be strong as well. But the other side of the coin is we are starting to see a slowdown in some of the manufacturing data starting to slow down. And just like we were concerned last year about maybe inflation just being runaway inflation, maybe the economy slows too much. Maybe the Fed overdid it by increasing rates so much to fight inflation that they put us into a more of a slower economy. And so that's something that we're looking out for. The debt ceiling, it's been in the news all year. I think this second quarter, this summer, we're going to see a lot of debate about what it is going to happen with the debt ceiling. Really, there should be a compromise. The government has to be able to operate and pay its debts. I mean, I think any American can agree with that, is that we should be able to find some compromise, and so that the economy or the government can run properly. And but that's going to be an issue, and there's going to be the way that we're seeing, kind of the fight line up, is that there's going to have to be some meeting of the minds in the middle somewhere. But that's definitely a point of caution if something on the outlier happens and the deal doesn't get done in a timely fashion. And then third, with the kind of divided Congress, probably won't see as many government kind of fiscal policy where we'll have the like student debt, for example, we'll probably have not as consumer friendly is what I'm saying. It won't be as consumer friendly as it's been in the past. Student loans will probably be starting to pay again. And the rule of economic thumb that we've been taught in the textbooks is that each interest rate increase actually takes 6 or 12 months to get kind of filtered through the economy. So we had this period of higher interest rates that you're starting to see in your car loans and your mortgage rates. Well, that's only been a short-term kind of time frame. We got to see that happen for another year or so, which also leads to concerns that the consumer is going to get stretched. Therefore, the economy slows down. So, right now we're cautiously optimistic about the economy, and if there is a recession, maybe it's a mild recession. So we're positioning our portfolios that way. In the fixed income side of things, as well as the stock side of things, we're keeping kind of high quality bonds and high quality companies where they are well positioned to ride out business cycles, maybe a little less demand, maybe more not as much maybe increased costs due to inflation. What the case is, when the economy slows down, we don't want to be too overly weighted to companies that are over leveraged, have too much debt. We want to be in the solid foundation type companies. Stocks, we're maintaining our international exposure. We do believe that's going to be a theme for the rest of the year, and we are, we're seeing that in the returns so far in 2023. We think that's going to continue. Fixed income, we're keeping our duration slightly lower than kind of the benchmark duration, and ultimately that leads to some higher yields. And that's actually what we did in our opportunistic sleeve, is that recently for most of our clients, we invested in a preferred stock fund, which pays around 6% and kind of yields more than your traditional short-term bonds. So we kind of get some more yield into the portfolio. And ultimately, this is a year for dollar cost averaging. This is a year that we're going to see some volatility likely come back over the summer. We've had a really, we sort of showed earlier, it was kind of less volatile early on this year. So some of the things with potentially recession, potentially economic slowdown, it could be volatile, but that's where we take advantage of. If it's to the upside, we'll sell into that that upswing and take some profits off the table. And on the flip side, if there is a pullback, we'll look to be putting money to work. And that is the definition of rebalancing, and in the definition of dollar cost averaging, just kind of keep putting money to work no matter what the economy and the markets give us. Any questions come in, Kat?
Yeah, we have a good one that often comes up during volatile markets, Matt. What are your thoughts on gold and how it keeps up with inflation?
Oh, yeah, gold. So gold is, historically thought of as a pretty safe investment, and we do get this question quite a lot, actually. Um, so typically speaking, if you go historically based, the gold typically keeps up with or barely keeps up with inflation. And when you compare that to the opportunity set that stocks, corporations historically provide, it's night and day in that the corporations and the stock markets are a better inflation protection because the companies can better pass costs through to, unfortunately, the consumer or different ways to make money. I mean, inflation, gold is really, it's a store of value. We really see it. It's really one part. When you think about all the commodities out there in the world that go into manufacturing inputs, whatever. If you looked at a list of commodities from like agriculture commodities like soybeans and corn to precious metals, gold and silver, it's really gold is only really one part of the commodity pie. And then there's just such a bigger investment world out there that we like to say really diversified and feel that you're better off into stock markets or even bonds that pay a dividend or pay interest. Gold just doesn't do that. Gold just doesn't do that. So ultimately, it's really something that we don't go too heavy into at this time.
Thank you, Matt. We have some other questions, but we're not able to answer all of them during this webinar. Some of them are personal. So if you would like to have your questions answered, we encourage you to contact your Tobias Financial Advisor. If you don't have an advisor, you're welcome to give us a call, set up a complimentary session, and we'll be happy to talk to you, review your portfolio, and just really understand your values and how we could align that with your money.
Great. Thank you, Kat. It was a pleasure presenting today with you. We hope everyone enjoyed it, and we wish everyone a great day.
Bye, everyone. Happy tax